Hey everyone, so this video is going to be about an investment that I've made and I've been studying this company for a few months now called Ashtead Technology. This company was founded in 1985, based in Scotland. I'll go through some other basics of the company, what it does, and then I'll sort of jump into the valuation, my thesis, why I really like this company. So I hope this gives you out there a very interesting company to go and do some further research in. So let me give you some more info. So Ashtead Technology they're an equipment rental company. Now they specialize in what's called subsea equipment. Now that's for the installation, maintenance, decommissioning of offshore oil and gas and wind. So I think their oil and gas is about 65-70% of the business. The wind is closer to 30% of the business at the moment. And 80% of their overall revenue across all of it comes from the equipment rentals, and the other 20% is in some servicing and software and other equipment sales and things like that. But this is an equipment rental company. Now they've expanded their fleet to about 30,000 pieces of like rental assets that they can rent out. You'll see in disclosures if you dig deep into this, it's the most sort of 2024 numbers. Everyone will say 23,000, but it's actually just gone up to 30,000 rental assets. So quite a big jump there. And I think we'll just jump into the valuation and what I think its intrinsic worth might be. So market cap at the moment, at the time of recording, is about 275 million British pound. The enterprise value, they've got a little bit of debt, sitting at around about 400 million pound. So this would be considered a small cap stock, but that is still a big company worth 275 million pound is still that's a big company. They've just been making some acquisitions recently. One called Seatronics, and that's their debt to EBITDA ratio at the moment sitting around about 1.6. Anywhere between 1 and 2 is sort of their range. They're hoping to keep. So 1.6 is about spot on. Anything over 2 when you're starting to creep up into sort of that higher debt zone, you start to get a bit more uncomfortable. 1.6 is fine, especially because they're paying this down quickly. So by the end of 2025, I'm expecting this to be at about 1.2, 1.3 x. So this is coming down quickly. Something that also is important when you dig into this company as well is to talk about depreciation. Now, it appears as though, and management have talked about this, that they're actually overstating the actual wear of the equipment. So what happens in accounting is you can depreciate things in a straight line. So let's say it's estimated that a particular piece of equipment's got 10 years. So you depreciate that by 10% per year, for example, let's just say. Now, what happens is, in other rental companies, is once it gets to a certain point, they often sell it on the second-hand market and get some money back for it, go out and buy new equipment, and that sort of depreciation is a really important part to factor into the equation in terms of their cash flow. Now, Ashtead Technology, they actually, even though they've said that they think something might last 10 years, for accounting purposes, they keep using it after those 10 years. So it's depreciated to 0, yet its useful life might still get another few years, 5 years, even 10 years. So by keeping it maintained and in working order, and you've had this with equipment before, its useful life, I haven't got a laptop here that you would think a useful life of a laptop is like 5 years maybe. I've had this for 10 years. Even though it's worth $0 right now, I still use it. It's fine. So physical equipment like that, depreciation is something that we do have to look at a little bit, but I think it's going to be overstated, is what I'm trying to get at. Now, this Seatronics deal that they've done recently, that added around about 9 million in EBITDA, and that was at the end of 24. So that really hasn't flowed into the numbers for 2025. So this is going to be sort of enhancing those forward earnings. Something that you're going to have to think about when adding this in yourself. So let me get into some of these numbers here. If we're looking at the run rate EBITDA at the moment, I don't really love the word EBITDA, but let's just go with it for now. So that's sitting at around about 75 million. That's what they'll probably do roughly for 2025. Now, adjusting for that maintenance capex, which is how we're going to adjust this for the depreciation of the equipment, like I said before, that's going to be at about 10 million. Now, they stated it at about 20, but like I explained, some of these things are going to zero, and they're still going to be able to rent it out for a lot longer than that, their accounting life. So we're going to call that about 10 million. Then you're going to minus some of the interest cost of their debt, so take another 10 million off that. Then minus the taxes off, which is like 25% roughly. So we're looking at around about 40 million in earnings. Okay, net operating profit after tax, I think it's going to be around about that 40 million mark 2025. That's a PE of about 7. It's about 6.8 or something like that. The enterprise value to net operating profit after tax, that's at about 10x. So even with the debt, it's still just 10x. And if you're looking at EV to EBITDA, it's only about 5x. So, and this is a company, now, if you were to buy this company and it wasn't going to grow, that's a reasonable investment to make. You're going to make your money back in about 6 or 7 years, roughly. Now, the good thing is this company is organically growing at around 10 to 15% per year, organically. That's not with the acquisitions on top, which they've been doing a really good job of making these acquisitions, averaging around about 5 times the EBITDA multiples they're paying for these. Therefore, as that continues and they sort of roll up the space a little bit, that's going to be another 10 to 20% on top of that organic growth. So we're looking at 20% plus growth for a company that's trading at single digit multiples. There's also a really long runway ahead here. So by looking at the space, the subsea rental equipment market, there is a lot of small providers all over the world, and Ashtead Technology are looking globally at this. So even though they're based out of Scotland, a lot of their work is not United Kingdom based. A lot of it's in Norway, a lot of it's in the Mediterranean, over in America, Southeast Asia, off Africa, off Brazil. It's the rental gear goes all over the world. That's actually a competitive advantage they have as well, servicing their customers, which are the customers that are building the offshore wind turbines and the offshore oil platforms and things like that, and maintaining that gear. That stuff is global, and these guys are serving this globally from offices in those different parts of the world. Now, I will talk a bit more about the industry position and that competitive landscape. So it is definitely a little niche segment that they're operating in. They hold apparently around about 50% of the global market share of one of their subsegments called survey and robotics. And the rest of that market share is split between some medium players and a lot of small ones. The mechanical rental market is very fragmented. A long-term consolidation opportunity is very obvious here. I think management talk about this as well. This is something that they really have this acquisition mindset, and it's something that they've been doing for quite a while now. And I think it's since 2019 since they've started going on this acquisition. I think they've made 9 acquisitions since 2019, and this is something they want to continue to do as it's a consolidation opportunity. Actually, the biggest competition they have is actually their own clients. Now, let me try to explain what I mean. Is their own clients actually have to make a choice by either renting the gear or buying the equipment themselves and using it, but then they also have to remember they have to store it, they have to maintain it, they have to account for it, they have that large upfront expense as well, then they have to depreciate it, so it makes them sort of capital heavy. So if their own clients want to go down that path, they can, and a lot of their clients do that and have done that in the past, but there's this massive trend towards being more capital light in this space. So Ashtead are positioned really nicely to take advantage of their own clients' wishes to rent more, essentially, and take assets off their books. So this trend of customers preferring to rent because of that equipment complexity and more capital efficient this way. So yeah, I think that's sort of the dynamics of the industry there. The structural advantages and the moat that the business has, they have scale. So it's taken a while to build up to the point where they are now, where they're starting to reach a place where they can get better asset utilization, because they can, if one of their clients is working off Africa, they've come to the end of that project, they might be able to rent it out somewhere else in West Africa, or they just move it over to Brazil or somewhere else in the world. They've got better asset utilization now because they're more global. So their cost utilization has actually improved from around about 35% once they make the acquisitions of these companies. It dips a little bit, but now it's sitting at around about 44%. That's for financial year 25. The most recent data has come out there about 46%. So their cost utilization is improving as they make more acquisitions and absorb those into the business. Now, they do also get some buying discounts for when they're going to buy this equipment from the OEMs. And the customers that they deal with, they also have a bit of a preference to deal with just one single vendor and buy multiple things from Ashtead Tech, rather than having to get a piece of equipment from these guys and a piece from over here and one from this part of the country and so on. The big reason for that is, you can imagine these projects, right? They're already using equipment that's costing them $200,000, $300,000 a day. And the products that Ashtead Technology provide might be only $3,000, $5,000 a day in terms of their rental costs. Now, that stuff is critically important to whatever operation they're making, whatever stage of the offshore cycle they're at, whether it's a decommission project or whatever it is. But if this equipment, they have to get sourced from different places, what can happen is it can show up at different times. So it turns into a bit of a logistical nightmare that, for project managers, you can imagine they're trying to get all the equipment at this specific time, so it goes out on the barge or however it's going out to sea. But if they're waiting, there's a delay from this company or a delay from that company, it holds up the whole project. So they want to work with a single shop, and Ashtead Technology are now reaching that scale where a client can just order all the things they need. It all comes in one delivery. It makes the project management so much easier. And that's really important to their clients. So this mission critical equipment, it actually, because of that element, it reduces the price sensitivity. So essentially, Ashtead Technology have these really strong margins because of this situation. Now, some growth drivers for the business: their revenues and earnings are growing at like 40 to 50% annually since their IPO in 2021. That's some significant growth. Now, remember, they're doing sort of strong teens, 10 to 20% organic growth, and then you're getting the acquisition growth on top. That's been going really well, 40 to 50% per year. Now, I'm going to be a lot more conservative than that, and I'm going to say that's not going to continue at those super epic growth rates. But even if you get sort of 10% organic, maybe 10% from the acquisitions, you're still looking at 20% annually growth. And I'll show you, you heard me talk about the valuation earlier. You're paying at steady state not even 7 times price to earnings for this company, yet you're still getting potentially 20% plus growth. Valuation is very attractive here. It got me very interested. You'll see the price chart when you go have a look at yourself, and it's sort of fallen off from the 800 pence range to in the 300s now. Hard to know exactly why it's fallen like that. I think it's a bit geopolitical. Oil and gas, everyone's going to say that that's a cyclical part of a cyclical natured business. And yeah, it is, but not only are their equipment can go on oil and gas projects, the same equipment, 85% of the equipment can go and work on wind, and they can also work in different geographies. So if America right now, for example, with the tariffs and the uncertainty that's going on, that might be performing a little weaker, whereas Asia is performing very strongly, and off Norway performing really well. So they can move equipment from that part of the world to this part of the world. And their asset utilization has actually been growing in this period. They also have because their clients are public companies, Subsea, Fugro, DME, and the likes, we can look at their backlogs. So they report their annual reports and things like that. And the backlogs that they are experience at the moment are only growing and getting stronger and stronger. So their clients have got more and more work to do. They're going to need Ashtead technology to continue providing the gear to these companies. So we can see into the future, which is a really cool aspect of this business too, is we're not guessing to see whether revenue is going to fall off a cliff or anything like that, or something's going to happen. We've got geographic diversification. So we've got, if there's any political issues like in America or the Middle East or things like that, things can move around. They can adjust pretty well. It's not as cyclical as you think. If oil and gas goes through a difficult period, wind might become more attractive, vice versa as well. And yeah, the backlogs that their clients already have are multi-years. So we're talking 2-3 years. We can see how much revenue they're going to be bringing in. Some of that's going to be flowing to Ashtead Technology direction as well as normal, because that's their client base. So I feel really confident that this isn't as cyclical as people might initially think. But the market is the market. I'll be honest, I really don't quite know why it's crashed so dramatically. Their earnings came out just recently. It's a little bit softer than what they guided for, but and the stock price fell like 30% in the day, but it's still going to be up like 25% for the year. So yeah, okay, their organic revenue had declined a little bit, but it seemed justifiably so. I don't know, it just seemed like a small, the business is not 30% worse than it was. Yeah, I actually think the business is better than it was 6 months ago. But anyway, I won't get my head too confused here with what's going on in the stock market. I'm just going to see it as an opportunity, I think. So the M&A, like I said before, they're doing these at 5 to 7 times EBITDA. Their reinvestment rate has been more than their free cash flow. That's why the debt has slowly increased a little bit, but they're not diluting shareholders at the same time. So it's these acquisitions are made with cash and debt, and I think they're doing a really good job of capital allocation. Regarding management and their incentives, the CEO, Alan, I'm going to wreck the last name here, Peary. Anyway, he's been with the firm since 2009. He's been the CEO since 2012. That's a good long tenure there. He holds somewhere between, it looks like about 1.7% of the shares outstanding. The CFO owns about 0.5% of the business. Now, they're not big insider ownership numbers, but it's actually pretty decent. So it's something there there's a fair bit of net wealth tied up into the stock. Their incentives are also based on earnings per share growth, return on invested capital, and the share price improvement. So I think that's pretty aligned with us as shareholders as well. I think that feels pretty good to me. I don't think, with the return on invested capital being in there as well, I think that's really important in their incentives. So, they don't need to, it's not like a revenue number or something like that. Criticisms would be so far that they haven't done any buybacks, even though I think this is significant undervaluation. But besides that, the reason why they don't want to do, they've talked about this, why they don't want to do buybacks is because they've just got a lot of runway to spend their money in organic and inorganic growth. And that's what their focus is just on that. They don't want to get tricky with trying to predict undervaluation of the stock price, even though they agree that it's significantly undervalued. The best use of their capital is expansion. I'm fine with that. So I don't think there's any issues there from a capital allocation point of view. Other risks, like I said before, about that exposure to offshore oil and gas, it can be sensitive to commodity cycles. So, yep, okay. We have to be honest with that. I think that if the oil and gas market collapsed, these guys would, the backlogs would get delayed and delayed and delayed from their clients. Therefore, their work would get delayed as well. So there is a risk there that there is a downturn in their revenues. Offshore wind, similar idea. That might, some subsidies throughout the world might fall off a cliff as well. So yeah, there is a little bit of cyclicality there potentially. I don't think it is wild like if you were directly tied to the oil and gas industry, like an oil and gas miner. I don't think it's as wild as that. So yeah, but there is going to be some cyclicality there, of course. A world economic downturn of any kind is going to affect this business too. They also don't have any sort of large shareholder, and that may attract some sort of takeover interest at these depressed valuations. That would be really sad. I want to hold this for a long period of time, as I think the returns are extremely attractive. I want them to just be able to continue what they're doing without getting worried about takeovers and things like that. So the return on equity, we're talking well over 30% here. That's more in the recent years. So ever since they've started making these acquisitions, they've really done a great job at getting that return on equity up really high. Return on invested capital around about that 25% mark. The growth of revenue and earnings, we're talking 40 to 50%. I think the earnings can be also misrepresented a little bit by that accounting depreciation, like I talked about earlier. So free cash flow is higher than I think is you would calculate based on specifically the income statement. I think the industry structure favors scaled operators rather than these small little shops that are geographically isolated. So if you were a small little shop based out of Scotland, for example, you might be able to work locally. Stuff that's happening around Scotland, that might be as far as you can get. Whereas the scaled operator, being Ashtead Tech, can send their equipment all over the world. So less downtime, less susceptible to political risk, things like that. And yeah, their clients themselves are moving towards renting more gear. They want to be more capital light. So some good tailwinds there. The M&A strategy, great optionality for us as well. So that's going to come not all consistently every 6 months. That might be 2 1 year, 0 the year after. We're not really sure. It's nice upside to have, but it is part of the strategy. So you can't discount this, and you can't say, oh, they're not. Let's assume they're not going to do any more acquisitions again. They're going to make acquisitions again. So I think we can factor that in our calculations too. They're also going to, this is just a small thing, but they are going to uplist to the London Stock Exchange. They're currently on the AIM. And I guess there's the opportunity that they might buy back shares at current levels, but they haven't indicated they're going to do that at all. They really have only ever said anything about investing more into their organic and inorganic growth. So that's a fair bit. I hope you might have to rewatch some of that if you want to, but that's a fair bit of the overall overview of Ashtead Technology and why I'm really interested in this. I hope that was a good starting point for you to go out and do further research. Now, how I've done the research on this so far is I first found this on Value Investors Club. There's a couple of write-ups from the last couple of years on the company. That was where I started. Then I've listened to the couple of earnings presentations that they have. Great. That's a great resource because the Q&A section of those were gave me all these little insights that I picked up along the way as well. So between the Value Investors Club, the annual reports, and the earnings presentations, how else did I pick up some information on this? I went to their clients and had a look at what their backlogs actually look like. And that gave me a bit of a picture on what the industry is doing as well. So that's helped. But I still have further to go on this. I'm in Perth, Australia at the moment, and I'm actually going to go and talk to a company that rents out Ashtead Technology equipment. They're sort of like an exclusive provider over in this part of the world for this equipment. So I'm going to go and try to have a chat to them and talk to them about what Ashtead is like to work with and what customers think of their equipment and things like that. So yeah, I'm going to go do some scuttlebutt there. Yeah, okay. I think that's enough. I'll stop there. Valuation is very exciting. This company is ticking all the boxes that I can think of. I think this is going to be something that AI is unlikely to disrupt anytime soon, being rental physical equipment. I really like this industry. The rental equipment industry is a really interesting place already. Ashtead Technology actually is sort of a bit of a spin-off from Ashtead Group over in United States, which is like Sunbelt Rentals, which you might be familiar with, which is construction equipment and front-end loaders and cranes and things like that over in the States mostly and in the UK. But these have been fantastic. Ashtead Group as a company has been a very good investment over the last 15 years. The other rental equipment companies, rental equipment businesses are actually really good businesses if you can get some scale, because the margins are really strong. The Ashtead Technology, their margins are sitting at, their EBITDA margins are 27, 28%, something like that at the moment. And it's consistently in that range. Their net operating profit after tax margins are about 20%. So that's a good business. That's a really strong business. That growth profile with those margins in this niche with the consolidation opportunity, this has got a lot of really, really good things that I like to look for in an investment. So, okay, I'll leave it there. Please talk to me more about it. I'm going to try to produce some more videos about this company as I'm doing some more research. I have made some investment into this business already, FYI. So please take this with a grain of salt. I'm going to be biased. I'm trying to reverse engineer what could go wrong here as well. And I'm actually finding that part pretty difficult to see what's going to go wrong. Again, trying not to be biased, but I'm obviously going to be biased because I've invested in this and I really like this company. So talk to me about it if you're interested. Otherwise, I've made this investment, by the way, with my Interactive Brokers account because I can get access to the AIM market. There's a link in the description below for Interactive Brokers if you need it as well. Highly, highly recommend. This is definitely the platform I need to invest in Ashtead Technology. And I think that's it. All right, I'll stop it there. Thanks very much. See you in the next video.